This is Professor Russell James coming to you from Texas Tech University. Welcome to today's lecture from Visual Plan Giving, an introduction to the law and taxation of charitable gift planning. Welcome to Private Foundations Part 3, Tax Rules. This is Professor Russell James. Once a private foundation has been successfully created, the primary guidelines for its operation come from federal tax law. Tax law affects private foundations indirectly through the deductibility of gifts and directly through taxation of investment income and levying of penalties for violations of IRS rules. Unlike other charitable entities, private foundations do pay taxes on net investment income and capital gains. However, this tax is relatively minimal, typically charged at the 2% rate. This 2% rate will drop to 1% if the foundation distributes charitable grants at least equal to its assets, multiplied by its average percentage payout for the last 5 years, or less if the foundation is not that old, plus 1% of its net investment income. For a private foundation intending to distribute the same percentage of assets in charitable grants as it had done over the previous 5 years, this rule means that the payment of 1% of net investment income can go either to the IRS by payment of the full 2% standard excise tax or to a public charity, thus reducing the IRS excise tax by 1% of net investment income. Although private foundations are not completely tax exempt, the burden of a 1% or 2% tax is relatively minimal. This tax is paid on net investment income and net capital gains. However, the tax is not paid on any unrelated business income, which is taxed at different rates. Net investment income allows for the reduction of gross investment income by any ordinary and necessary expenses incurred in generating the income, such as investment management fees, real estate management fees, or the share of officer or employee compensation related to investment and investment management. As discussed in the lecture on that topic, gifts to private foundations have lower income limitations for charitable deductions than do gifts to public charities. The highest 50% limitation is never available for deductions from gifts to private foundations, which are instead limited to 30% or 20% of adjusted gross income, slightly modified, for individual taxpayers, and 10% of taxable income for corporations. Any deductions from charitable gifts in excess of the maximum percentage of the donor's income cannot be deducted in the year of the gift, but must instead be carried forward until such time as they can be used without causing the total deductions to exceed the relevant limitation. Carryover deductions that cannot be used in the 5 tax years following the year of the gift will expire. As discussed in a previous lecture, gifts that may be deducted up to 50% of all income are all gifts to public charities. Gifts to private foundations of cash, inventory, short-term capital gain, or ordinary income may be deducted up to 30% of the donor's income, with the remainder carried forward. Any gifts of long-term capital gain to a private foundation may be deducted only up to 20% of the donor's income, with the rest carried forward into future years. This is true regardless of whether or not the gift can be valued at fair market value or the lower of basis or fair market value. This has been Private Foundations Part 3, Tax Rules. Join us next time for Private Foundations Part 4, Insider Benefits.